This episode of That Podcast in Hutch is brought to you by me. If you'd like to learn about how you can sponsor future episodes of That Podcast in Hutch, please reach out to me at thatguyinhutch@gmail.com or through my social media channels, which are also That Guy in Hutch. Thank you. Hey everyone, this is That Guy in Hutch, Jason Probst, and you're listening to That Podcast in Hutch. I'm really fascinated about this week's episode, and it's, I think, really timely, partly because I've been having conversations with people in the community about homes and, in particular, homeowners insurance, which I think we have a lot of conversation about the housing crisis and what we need to develop housing in a place like Hutchinson. There's a lot of dynamics at play there. You know, builders don't want to build in some areas because it's not profitable. And there's a lot of things that come into play. But one thing that I think has been overlooked that I've been hearing a lot lately about is homeowners insurance. So I asked my friend David Inskeep to come in. He owns Joe McGuire Insurance up on 30th Street. And I called him and said, will you just talk to me about what's going on? Because people were telling us that it's really expensive to insure a roof. Sometimes people are backing out of deals on buying houses because they're finding out that the roof is going to be excluded or they're only going to pay a fraction of the cost. So insurance is an incredibly complicated system. And I thought David knows a lot about this, so I'll have him come in and explain all of this. I found it a really fascinating conversation. I have my own feelings about insurance, particularly health insurance, but also, you know, I think there's room for improvement in all the insurance areas. But one thing that I know that we talked about, and I think at the front I want to talk about, insurance rates have gone up dramatically in the last several years. And in this conversation, I reference a report by the Consumer Federation of America. It indicates that the average rate of increase in homeowners insurance has gone up about $628 a year. Totally in the country, it's been about a $21 billion increase. And Kansas already had high rates, and we are, I believe, within the top 5 or 6 most expensive states for insurance because our rates run about $4,200 for every $350,000 worth of insurance. So we even in Kansas, we tend to think about having like a lower cost of living, and we think that, you know, that things are relatively inexpensive here. It turns out in some areas that's not the case, and certainly in homeowners insurance, that's not the case. So I really had a fascinating conversation with Dave. I think you'll enjoy listening to it. I guarantee you're going to learn something because he tells me and talks with me about a lot of things regarding insurance that I did not understand. So I'm going to just turn you loose, let you listen to Dave talk about insurance, which he assured me he could talk about until we were all bored, but I never got bored. So I think it was a good episode. All right, I have in the studio with me today David Inskeep, who is an independent insurance agent, which means he's not tied to any one company. He works with a number of companies. And I asked him he's with Joe McGuire Insurance, and I asked him to come in today and talk about particularly homeowners insurance, but we can talk about any insurance. But because I keep hearing from people that you know, homeowners insurance has gone up quite a bit in the last few years. Some states I'm hearing they're like insurance companies are pulling out, and it's really creating a barrier to home ownership and home development. But my first question is, why is it Joe McGuire Insurance and not David Inskeep Insurance?
Great question, Jason. Thanks for having me today. I appreciate the opportunity to talk about insurance. It sometimes falls on deaf ears in my household. They think I drone on about it ad nauseum. But if you think that your listeners might find some interest, hopefully it'll be a good conversation. So Joe McGuire Insurance was actually started back in 1911 by a guy named Bert Berry, and then he partnered with a Joe McGuire. Then Mr. McGuire bought him out. His son bought him out, and I eventually went to work for Joe McGuire and bought him out. The reason I've kept the name the same is, I don't know, probably just because at the time when I purchased it, more people were familiar with Joe McGuire than they were with Dave Inskeep. But as time has gone on, there are more questions about who's Joe McGuire? Why is it called Joe McGuire? I kind of jokingly say that if you enjoyed your service and we've done a good job, well, you can thank Dave. However, if you had a bad experience, feel free to contact Joe. So
put it all on him.
There it is. There it is.
So I don't even, insurance is such a big topic, and we had a little bit of a conversation beforehand, but maybe let's just start with the bare facts of it. I was looking through a report this morning. It said that Kansas is one of the 5 or 6 most expensive states for homeowners insurance because the premiums are like around $4,200 per $350,000 worth of coverage. From 2021 to 2024, there's been significant increases. I think total across the country, the report I read, about $21 billion increase and about $648 per customer. And I hear anecdotally from realtors and bankers and lending institutions that this is really proving to be a barrier in the home market. So can we just start with talking about what kind of has happened over the last several years with homeowners insurance?
Sure. Some of the things that come to mind right out the gate that we weren't dealing with as much prior to was the increase in natural disasters. Specifically, again, across the board entirely, but specifically in Kansas, whereas our largest claim activity at the time used to be the perils of wind and hail, still are for the most part, but we've introduced fire that was never really a large presence, but with the grass fires and wildfires that we've been experiencing, just like other states, those claim costs have gone up dramatically. The cost of the claims have gone up dramatically also because of the cost of inflationary cost of goods and labor and things like that as well. So the sheer amount of claims that are being turned in and then the cost to pay those claims are coming in. Even though each company sets its rate for its individual state, it has to contemplate the big picture and things that are happening in other states once you get high enough on the pyramid. And so that then would certainly include some of the stuff that's happening down in the Gulf Coast area, which would be hurricane related, and then, of course, on the West
California.
Coast. And even in the middle states in the mountains and stuff with the forest fires.
But on the other end of it, we talked a little bit before. You indicated that even in Kansas, we have an average 14% increase in that period. But some counties saw a larger increase.
Sure.
And maybe some saw a lower increase. But there's a very granular level examination, but also a very macro examination of insurance.
Correct. And when an insurance carrier files its rate with the Insurance Commission, specifically in the state of Kansas, they do have it rated down, sometimes as much as zip codes, that they say what the rate's going to be. So when we're talking about that 14%, that's an overall for the state of Kansas. That doesn't necessarily reflect, for example, what's happening in Reno County, maybe specifically even in Hutchinson within Reno County. So some places, although the state took a 14%, there might be places that took a 30%, other areas that maybe only took 2%. Some justifiably could have taken a decrease. But whatever that was, when you add it all together across all the various zip codes in Kansas, you net out at a 14% increase.
Okay. So you mentioned, so it's interesting to me, there's like all these different factors that play into, like, from a homeowner's perspective, we get a premium statement that says you owe this, and then if you're the person that pays it once a year, you grumble because you got to write a big check.
Correct.
If you're the person that escrows it and has it paid out by your bank, you're grumbling because your house payment went up $100 a month, and you look at your taxes too, and you see
as an insurance person, we attempt to point you towards your tax liability. But yeah, it's definitely going to be a reflection of both, and even more so lately, insurance is certainly a part of that increase in your escrow.
And so, in factoring that, you're looking at like county level data to say what sort of things are happening there. You're looking at national level data. And not you have underwriters that are doing all this. You're looking at the increase in housing, which was dramatic between 21 and 24, the price of housing, but also the price of lumber and all the things needed to rebuild after a fire have gone up. So like, I'm guessing that one of the things that factor into this is like a $250,000 house burns. Probably the construction cost to rebuild that same house today is probably closer to $455.
You hit the nail on the head, and that's another part that's probably going unnoticed on most people's insurance policy renewals. Again, your eye naturally gravitates right to the bottom line. Mm-hmm. What's it going to cost? What's often missed is what changes have been made to the policy, good and bad. And it's all listed in your annual renewal. But what a lot of people miss is...
Which everyone reads.
Oh, of course. It's
like the Apple or the Google user agreement.
Yeah.
We have no idea what we've agreed to.
What we've actually agreed to. Click here, pay the bill, let's move on. There are some assumptions made in insurance, again, that whatever I've chosen is still currently in my best interest. So it's probably advisable, again, to speak with your insurance agent professional to go over those renewals if you have the time to do so or the inclination. But what you might find there is that the replacement cost on the property has gone up. There's been a real trend within most carriers to properly insure the home at the appropriate replacement cost. If the contract is a replacement cost insurance policy, then the company is obligated to pay you what it would cost to replace it. Your obligation is to pay a premium that's commensurate with what the replacement cost is. That is a number that a lot of people don't understand. Some do, but we also want to kind of suppress it. Well, I could never sell my house for that. Well, that is not the number we're talking about. It's not appraised at that. That is also not the number we're talking about. We're talking about today's lumber, labor costs. What would it cost to replace your home? And a lot of insurance carriers found that they were woefully underinsured, and so now they're playing catch up. So not only have they raised rate, they're also raising coverages, and so you're feeling the shock of both of those things.
But there's another thing that's happening too that I've had some conversations about, where they're saying, well, we're going to give you like the depreciated amount of this. Like particularly on roofs, we're seeing this a lot, right?
Correct.
Where your roof is 20 years old. It's going to cost $12,000 to $15,000 to replace it, but because it's 20 years old, we're going to give you like 30% of what the replacement cost would be, and that's a change that we see on some policies too, right?
And again, I only represent I represent quite a few carriers, but I don't pretend to represent them all. The contract that I think you're referring to would be a replacement cost contract. Normally, it would pay out on a depreciated basis, but once you fix the roof, then you can apply for for that holdback.
Okay.
And then they would do that. Now, I'm not suggesting there's another new tool in the toolbox that some carriers have subscribed to, which is a roof schedule. And again, specifically to roofs, because that is probably our loss leader in Kansas is wind and hail to the roof. But they've subscribed to a roof schedule to help offset their costs. If you fall under the roof schedule, and that usually applies after a certain fixed amount of time, usually it's somewhere between 10 or 15 years on the age of the roof, then they will actually have a sliding scale where you can take your finger and say, roof 10, I have an asphalt shingle roof, and wherever those two meet, there's a percentage, and that's what you're going to get paid. Mm-hmm. That's a deviation, and that is in the policy, and it only comes into play if your roof is above a certain age. So you'll definitely also want to make sure that your insurance company is aware of your actual age of your roof, because you wouldn't want to inadvertently slip onto that roof schedule that some companies, but not all, subscribe to.
Okay. And roofs have gotten really expensive.
Roofs are not inexpensive. They're petroleum based, and the cost of oil you can watch as things go up and down and things like that. Yeah.
So talking about some of the history, like talking about like the changes in insurance, we talked a little bit before about like there's some changes that we've seen, like credit scores became an introduction into this, and also we had a little fun conversation about there was a time where I remember people would do this. They would just every little thing that happened in their house, they'd make a claim. And those days feel like they're long gone now. You have to be in really pretty dire straits to make a claim on your insurance anymore because you just don't want to make those claims.
And I think you're on the right track there. And I think a lot of consumers have become aware of that. Some the hard way, certainly. There was a time and a place historically, and not that long ago. You've mentioned earlier some dramatic changes between 21 and 24, but it wasn't even that long ago that I could say with a certain amount of certainty that there was premium would see increases. Everything tends to trend up. But if you didn't turn in a claim or if you didn't do this, there would be some stability that you could expect. I have people approach me on a daily basis, but Dave, I didn't even turn in a claim. I didn't do anything. Why is this? I have to remind them, or not remind them, but let them know that they're not being picked on individually, although it feels that way.
Sure. Well, it does when your insurance premium goes up 30%.
Yeah, it's my premium, and I'm paying it. But that's across the board. That's that 14% that we talked about. And so, well, why is that? And again, I didn't turn in a loss. Well, it's all the cumulative other losses, and it's not even specifically the losses last year. It's over time. The insurance company is a for-profit business as well, and it I think has gotten used to a certain level of income and things like that, which I don't necessarily agree with. But they've grown accustomed to offering dividends to the stockholders at a certain level, whatever that may be. With that in mind, rather than peel that back, I think they've found a way to increase income and to help offset the losses and things like that. Credit is that's in the history of insurance is a rather new deal, but I would say it's been on there for 20 plus years now. But in the grand scheme of insurance, it's a rather new deal. We had talked about it earlier that there's a credible data that points that there's a connection between credit score and likelihood of an individual turning in a claim. The data's there. I've read through it. It's sound. What I disagree with, and I've always adamantly disagreed with, was that there's always outliers to that, and there's some situations that maybe a lower credit score may be not due to some sort of financial irresponsibility, but rather to some circumstances that are beyond your control, medically related, other things.
Yep.
And I do not believe that most carriers have a way to appeal that. Also, each carrier files their own credit scoring mechanism, and it's all proprietary, and it's all hidden from sight. So I, as your insurance advisor, am relatively incapable of helping you to fix whatever problem there is. If you were to go to a traditional lender at a lending institution, they could at least look at your pure credit report and tell you, well, here it is. You have a late payment. Fix that, or it will go away with time. You have too many open accounts. Fix that, or it will, whatever. I purely, depending on the carrier, might see a letter. I might see a number. That number means something to me. I can divine how it may or may not impact your premium or even your ability to get insurance. But I can't tell you what the problem is nor how to fix it.
So in that case, you're not able to help at all. I mean, it is what it is.
It is what it is. There's an 800 number that you can contact one of the various bureaus, but really all you're going to get from them is a copy of your credit score. And even then, I'm just educated guess. I could tell you, okay, yeah, you've got some late payments, you have some other things. Those impact your empirical score, but this carrier goes purely off the score. This carrier takes that and only uses it as a percentage of how they divine the premium, and so each one's unique. It's I don't necessarily agree with it.
Yeah, well, it's a tough. I mean, like you said, at the end of the day, these decisions. I mean, you're the agent, so you're the front facing with the customer. You're you have that interaction with the customer, but behind you is there's a whole. I mean, there's the insurance companies, there's the underwriters, there's
Correct.
Reinsurance, there's actuarials who are plugging all this information in and making handing you basically like, here's what the premium's going to cost.
It is, but we educate ourselves to try and understand the process so that we can help counsel and have conversations like this. But you're absolutely right. We are the point of sale, and I found that POS has a couple meanings. And so with that in mind, we try and advise, we try and give guidance, I think I'm in a unique position because I'm in the independent agency space, which allows me a wealth of different options. They may not all be great options, but I have options. In the current environment, you listed 2 states right off the bat, I should say, Florida and Louisiana. I've got good friends that sell insurance down there, and they're having difficulty finding markets at all.
Yeah.
They have a single carrier in Louisiana that writes home insurance outside of the state program. I think Florida is in a very similar boat. We are way better off in Kansas than they are. But those type of things are happening. I had a carrier, I won't mention them by name, but they're affiliated with a larger insurance and larger group, completely pull out of homeowners insurance completely in the not only in the state of Kansas but in the nation.
Wow.
Yeah, and so those type of things I have not seen in my 25 plus years of insurance. But they're happening, and even it's some of that ripple effects is even happening in Kansas.
What happens what's the effect of that when insurance companies pull out of the market, or they say we're not going to cover, like that Louisiana and Florida, like it's pretty well documented what's happening in Florida. Really expensive homes, high incidence of hurricanes, and a lot of damage when they happen. These insurance companies are just like, we're not going to insure here. What happens? What happens with homeowners in that case?
Well, again, competition drives the price down, so lack thereof has the opposite effect. So that's why they're seeing historically high numbers in those areas. And they were high to begin with. But without that competition in the space, and they're doing that, it limits their options. Again, if you have a mortgage and it dictates that you're going to have insurance, you're going to purchase it. So some folks, I think, are having to find ways to finance that into the purchase of the home, maybe. We're not seeing it in Kansas, so I'm speculating, but it's the same question. If you don't have a mortgage, then it might be very tempting to go without property insurance. I've had inquiries in Kansas as people have paid off their notes. This is ridiculous. I'm paying X amount of dollars. I never have a claim. If I were just to set aside that $4,000 annually for X amount of time, I could pay for a roof. I could do this. And they're not wrong. But the conversations then we usually go back to is there's also the liability exposure, which can actually be greater than the roof loss could be or another type of loss. Whereas your dog bites somebody and gets sued for $1 million, you're going to wish you had that liability piece, or at least a portion thereof. So nobody's taken me up on it yet, but we have an ability to sell just standalone liability insurance. And I've had those conversations, and I've cautioned. I'm an insurance guy, so I'm going to promote insurance as a tool to help protect you and things like that. But I understand that there are real-world things happening out there, and people are making real-world decisions.
And they're tough.
And they're tough.
Let's talk about this a little bit. So if you have because I was reading about this morning, there's something called like a forced place insurance, where if you can't find insurance, you can't get it. Like the bank basically finds a policy and because the bank is if you have a mortgage, the bank is gonna protect itself.
Correct. So,
but that policy only covers like the bank's exposure, right?
Correct.
Yeah.
And that's what they call single interest, and the interest they're representing is the lender, and so it's going to pay off the note to them. I'm not sure that it necessarily releases you from your obligation that you may have had to them, but the bank will be made whole. And I don't fault the bank in that scenario. They've got to protect their interest as well. But some people are confused to think, well, the bank's got the insurance, I'm insured. That is not the case. The other thing that we mentioned too, or you had mentioned, is what happens when insurance carriers continue to pull out. I told you competition goes away, prices go up, but with credit, with claims history, with other things, if you don't fit in what remaining carriers are available, the state of Kansas and most states have a plan in place. Ours is called the FAIR Plan. And it is the place you go when nobody else will take you.
Okay.
The problem with it, and what I've seen over time, is I think there were certain agents that were taking advantage of the program. The rules of the program are that you are supposed to be declined by 3 standard markets, and if you're declined by them, then you can go to the Fair Plan. At the time, the Fair Plan pricing was dramatically cheaper. The coverage was also dramatically less, but again,
would it satisfy the needs of a mortgage?
It definitely would satisfy the needs of the mortgage as long as it met the loan amount or whatever. But even the bank probably isn't aware of what they've got, like from a coverage standpoint. They just see a piece of paper across their desk, a certificate of insurance that says there's X amount of dollars, and they make the assumption that that's going to meet their needs. I argue it may or may not, but I don't know that they're trained to know that. The consumer, he's going to take my advice. Well, this one's cheaper and it's going to meet the thing or whatever. Well, in reality, you're almost cutting your throat on coverage on certain things because it's very, very limited. What's probably going to correct that is I've noticed a dramatic increase in the Fair Plan's pricing as well.
Yeah.
And I should say, too, their underwriting guidelines, again, this is where you go when everybody else turns you down. So you should theoretically be able to get in, but there are occasions where even they turn it down. But then you have to insure the property for actual cash value or the appraised amount, whichever is less. And so it's going to be a very, very small amount. And now for that very small amount, it's also a much, much higher premium. So I think that will start to correct itself somewhat because it's just as expensive to go there and it's way less coverage. People will start going back to the standard market because, again, it was supposed to be if you couldn't go anywhere, not just because the other one just cost too much. Actually, if you said that you had a standard market quote, the Fair Plan should not accept an application from you. If you can get it through State Farm, Allstate, American Family, the Fair Plan should not issue the policy. You can't just rely on it because the Fair Plan was cheaper.
Okay. But that may have been misused a little bit, or it feels like maybe they're...
I can't speak entirely to it, but sure. I know some people have approached me with policies that are in the Fair Plan that certainly didn't have to be.
Yeah.
Didn't appear to need to be, but it was cost less to do so.
Well, okay, so we talk a little bit about the credit issue, and what I find a little bit ironic about that is that your premium will be higher based on your credit score. I mean, sometimes they'll deny you, but if your credit score is a little bit out of whack, the premium might be higher. There's also a correlation. We talked a little bit about correlation causation.
Sure.
But in this report that I read, there's some correlation between higher premiums and like a decline in the property, like it's allowed to deteriorate. There's like a 20%, for every $500 increase in premium, there's like a 20% reduction in the basically the maintenance of the property. Like the people take money that they would have spent on maintaining their home and they're paying it on a premium.
Okay.
So they're not maintaining their home as well.
I'd not read that. I'd not seen that, but there's logic there. I could see that. You got to take it from somewhere to put it somewhere else.
Well, one of the things that's fascinating to me is, notwithstanding my feelings about what happens in the industry altogether, is that it is like a very interconnected system, right? There's nothing that's happening in the world that's not woven into some aspect of insurance.
Sure.
Right?
Okay.
I mean, tariffs on lumber increase the price of Canadian lumber that's used to rebuild a home that's destroyed in a wildfire. That is going to have an effect on your insurance premium. All of that's connected.
Oh, 100%. And I mean, for those of us old enough to remember 2008, I mean, that was labeled a housing crisis, but there was so much involved in insurance and reinsurance of different things that, if not for the industry, and it does get a bad rap, but it serves its place, the whole system could fall apart, and because it takes a collection insurance of things to offset risk. Yeah. Otherwise, it just wouldn't be possible. But with that being said, it's the credit piece, again, somewhat sticks in my craw because of just the inability to help an individual make it better, or the inability to know from company A to company D what is going to impact them, and is it going to affect just rate or even their ability to get insurance, which some carriers, I did have a prospect that got turned down from a carrier. They did an okay job of explaining it. They sent out the obligatory letter And theirs actually had some piece, and they brought it in, so I was able to read it, that it was too many open revolving accounts. But that was not premium based. That was lack of entry. You cannot get into this company.
Oh,
yeah. So they just flat turned them down for that
Turned them
reason.
down.
Which, when the credit was first introduced in the state of Kansas, if memory serves correctly, that wasn't allowed. They could adjust rate, but they couldn't deny. Sometime between here and there, somebody passed a rule.
and said you could deny based on credit score
I say that I now that I'm thinking about it, I might have to go back and make some phone calls
and see what see what happened.
see if that's okay. I took it at face value and I moved it to somewhere else, and we end up finding a carrier for the individual. Life goes on, but I may, now that we're having this conversation, I may go back and make sure that everything was cricket with that.
Yeah. So, and one of the things I read in this report that I looked at this morning talks about the effect on communities. So it's not just an individual issue; it's a community issue. And when you talk about credit scores, you're also, there are dual things that it talked about in the report. One is that in high cost areas like Florida, you end up with people fleeing because they can't. Their property is worth a lot, but they can't insure it. And they can't afford the insurance. And then if anything happens, they're just leaving when their house gets destroyed. The other is that in lower income communities where there's houses that are worth less, but they cost a lot to insure, and people with lower credit scores that can't get them insured or can't affordably get them insured, you're seeing further decline in those neighborhoods. And we talk a lot from a policy perspective about housing. Do you feel like we're having enough conversation about what to do in the insurance field? Because it feels to me like there should be, from a policy perspective, some look at what do we do about insurance premiums for homeowners if it's proving to be a barrier to housing development, which everybody has agreed is a problem in the state.
Yeah, and now that you got me thinking about it too, you mentioned earlier something to the effect of if we're paying the higher premiums, we're not investing back in the upkeep of the property. It also occurs to me that there's probably individuals, because I see it, where they're let me preface this by saying, although I'm licensed to sell health insurance, I choose not to do so, and I made that choice a long time ago. And that is an entirely different conversation. And you think the property insurance is a racket? Let's have a different conversation about health insurance one day. But and I know you've
I've been fighting with them for a month, so I'm fired up.
But there are some similarities in the sense that much like on healthcare side, people are taking out super high deductibles or minimum coverage or catastrophe type policies. In health insurance, we say just if I get cancer, or whatever. There are individuals that are doing that as well with high deductibles on their property insurance, which then occurs to me, if they did have damage, but the damage did not exceed their deductible, they're not going to be compensated. They still have the damage.
Yep.
They're not going to repair it because they're in a position where they can't.
Yeah.
And so that's further going to deteriorate the property.
And we see this a lot I've seen this when we do like cleanup days or go try to help people after storms. There are people that they have storm damage. They don't have insurance on their home. They're going to keep living in the home.
Correct.
Because it's what they can afford and it's what they have. They just don't have insurance. And maybe they inherited it or maybe it's paid for or whatever. But it's a functional decision that they just don't have the resources to maintain a household and pay the insurance.
And it's just a continuing cause and effect type situation. So perhaps they want to go and fix the siding, fix the roof. So they approach their local lender to get X amount of loan to do so. Well, that's going to obligate them to get insurance, which is an additional expense above the loan repayment.
Yeah.
If they can even get it, right, for the reasons
because the house
earlier.
might be deteriorated to the point that it doesn't have a lot of equity in it.
And all of a sudden, I can't put them anywhere but the fair plan because of the condition of the property.
Yeah.
My standard markets may not take it because they said, no, we're not going to take it. The roof's already bad.
Yeah.
We're not going to insure something that already has losses on it or whatever. And so it just keeps going. It's a cycle. So they can't get the loan because they can't get the insurance. So they can't fix up the property. So it continues to deteriorate. I could see it.
So there's it's just interesting because there's so many community and well, not just community, but community, state, nation, global aspects to this. And like you at the beginning of the show talked about fires. Like this isn't something that used to be a big factor in Kansas insurance. The actuarials weren't sitting around thinking about wildfires,
Right.
but we've had drought.
Yeah.
And I know I was involved in a task force where they said wildfire season used to be like January, February, March until things greened up. Now it's all year long.
It's true. And again, bringing it out to the macro, but if you look at the largest insurance catastrophes in the United States, going back 100 years, of the top 10, the majority of those forever and a day used to be hurricanes. Recent wildfires have crept into that top 10. They rivaled what a hurricane could cause in damage, and that would have been unheard of or unthought of back in the day. And those things are, I wouldn't say, well, they are man-made in a certain respect. Drought, one could talk about climate change, but also where we've chosen to build and do different things like that. Because
we build in areas that are prone to those things or hard for fire departments to get to.
Exactly.
Yeah.
Any of a number of reasons. And again, that has a ripple effect too. So it wasn't my decision that somebody else chose to build in the middle of a forest, but I'm indirectly paying the price for them to do so.
Yeah.
in a trickle down type
and
of
it moves,
effect.
and it affects all the premiums.
Yeah.
The fire thing, and we are seeing more of that. And then, of course, like we talked before, then when you go to rebuild, that it's more expensive,
Sure.
and the price of the land has gone up, and so many things that factor into this. You had said something that I was trying to think of a question around, talking about the history of insurance. You had talked about there was one point in the history of insurance where it was very specific. It was like
Sure.
this policy covers your house from fire.
And that was it. What we've all grown to know as consumers and as representatives is the traditional homeowner's policy, but it's actually a homeowner's package. And what they did was, in their wisdom, they packaged together all these various coverages. If you go back to Mr. Barry or Mr. McGuire or even his son, when they wrote policies, they would write policies based on the peril. So they might write a fire policy, but you maybe have a little extra money in your pocket and you want to also insure for theft. So we would add theft to that. Again, you want to sleep better at night, so then you wanted some comprehensive personal liability. So we would add that. So we would build a package with individual policies. They'd have different premiums, different potentially different effective dates or not, but they would be their own individuals. Well, sometime, and I'm a study of history, but I don't recall the actual dates, they, in their wisdom, came up with what they called a homeowner's package. And there's HO1, HO2, HO3, and that's basic, broad, and special form coverage. In the basic and the broad, it's going to be a named peril situation, which means that in order for there to be coverage in place, it has to be a named peril. You have to find in the policy, do we cover fire? Do we cover lightning, wind, hail, etc.? The special form coverage has a different approach to it, and there's some coverages within the policy that dictate if everything's covered unless it's specifically excluded. And some of the exclusions you would recognize would be flood, nuclear disaster, war, things like that are just standard baked in. They're excluded. And if it doesn't fall in those, then you're going to find coverage. So I use the example, does it say that the dog knocked over the cup of Kool-Aid on the white carpet? If it doesn't say that, it's covered. Different things like that. With that being said, contents are still on a name peril basis, so your belongings would still be subject to fire, lightning, wind, and hail.
Okay.
But or all the named perils, I should say. But a lot of people don't understand that, and because of that decision to make that, and I think it came from insurance carriers trying to outdo the other and justify why their policy was better. It was broader. Look how much more stuff we cover. They kind of did it to themselves and created a situation where everything was covered. And there was
they could charge a little more for that premium, right?
And they could absolutely do that.
Yeah.
That was a justification for a little bit of cost. And at the time, the costs were somewhat reasonable.
Yeah.
The cost of a home was reasonable at
Yeah.
the time that they were making these decisions. I think when they made these decisions, they weren't thinking that homes could be built for hundreds of thousands, close to millions of dollars, and so with that, then the people took advantage of what they paid for. Took advantage may not be the right word, but they utilized what they had paid for, and they would turn in the losses, and that compiled over time. And some of those were larger losses, and some of those were continued losses. So that's when they started introducing claim-free discounts and things of that nature. If you look at your, I laugh, but I don't laugh. If you look at your standard renewal, you will see the cost of the premium, but then there's also usually, depending on the carrier, some verbiage in there about all the money that we're saving you with all these great discounts. And it's true. The way the rates filed, those are discounts, so you're getting those. But what happens then is the minute you turn in a claim, not only do you lose the claim-free discount because it went away, you've used the claim, but then you're also prone to rate adjustment because you turned in the loss.
Yeah.
And so it's almost a double whammy.
Well, this sort of creates a vortex that I want to talk about because I actually had some experience with this. There are people, so we went through a period where people would make claims on everything. Like we were joking about, they get like a little paint chip on the house. They paid for this like Cadillac policy.
At the time, you could afford $50 deductibles.
Yeah.
Or zero. There was actually $0 deductibles.
Unbelievable. You can't get a deductible for less than $1,000 now, can you?
There's one carrier that I represent that still offers a $500 peril, but I think it's going the way of the dodo very soon.
So you had this, this dynamic where like people were like, oh, let's just make claims. Let's make claims. We're paying for this. It was reasonable to pay out. Insurance companies could pay it out, still make some profit. And that goes on. And then there's this other, then things change a little bit. And then you also have another group of people who just resist making a claim no matter what because they're so terrified of their insurance going up or what's going to happen when they make that claim. But now we're finding like if your roof is past a certain age and you haven't made a claim on it and it's older than, say, 10 years old or whatever, then your insurance company's like, whoa. That roof is way too old. We're not going to cover that.
Right. So there's a couple different things, and I always, again, qualify that I know the underwriting rules of the carriers I represent. I don't pretend to know the ones that I don't, but there are broad similarities across the spectrum I've found in the policies that I've read. But yeah, there are. So if you had an older roof to begin with, that may preclude you from getting insurance from a standard market in the first place, just because the age of the roof is bad. We recognize it's just the way it works, that a newer roof applied recently has some flexibility. It's pliable. It's still soft, so to speak. It can absorb a 3/4 inch hail hit and bounce back. But as you have 10 Kansas summers and winters, it becomes much more brittle over time, and a much smaller hail impact can have devastating effects. So with that in mind, they decided that, again, some carriers chose that if the roof is beyond a certain age, they just won't even touch it. You're just don't submit the app. And others, then the rate can be commensurate with the age of the roof. We've got one carrier specifically that if you have a brand new roof, this is your rate, your premium for the year. And that same home, same everything, but with a 10-year-old roof has this rate involved. Another thing that you and I discussed in the build-up to this was the roof schedule. Some carriers have subscribed to that as a tool in their toolbox to try and offset losses and costs. And essentially, if your roof goes beyond a certain age, then it will fall onto the roof schedule, and there's going to be a fixed percentage of whatever they'll pay. So they'll find out what the replacement cost of the roof is. Then they'll slide their finger down one side to see the age of the roof, the other side to see whether it's tile or shake shingle or composition. When the two fingers meet, that's the percentage that you'll get of the replacement cost of the roof. And it is not a depreciated amount. It is a fixed percentage. And again, some people, although they should be made aware of that in their renewal, if you're not reading your renewal, you may not know that you've slipped onto that schedule.
Well, let's talk about this a little bit. For consumers, what sort of things should they do because insurance is complex. It's complicated. You live in the world. Most of us approach it, I don't think I'm speaking out of line when I say this. Most of us want what we got to have. We want to be reasonably covered. for as little money as possible and as little hassle in our lives as possible.
Correct.
And I'm not looking to spend a ton of time going through a manual to figure out all the nuance of my policy. So what should consumers do to make sure they're getting what they should have, to make sure they're adequately covered?
Sure.
I mean, there's talking to you, but what other things can they do to kind of inform themselves?
Exactly. And yes, and not to toot my own horn, but yes, a strong, knowledgeable agent that knows policy and history. There are those within our space that are great sales people, and then there's good insurance people. Mm-hmm. And the insurance folks know the inner workings of the policy and how it's going to affect you. They don't sell on price, although price has to be a consideration. But they make sure that you're getting what's good for you. So visiting with the individual. Your own homework again, read the renewal. I know it's painful. It's 30 to 40 pages long.
Can we plug it into AI now and just let AI do a summary for us?
One could argue if you had a PDF or something, maybe you could
put it drop it into ChatGPT and say, tell me, maybe I could do 4 different ones and have it shoot out like summaries for me.
It wouldn't be a bad idea.
And then ChatGPT hallucinates and starts telling you all these things about what coverages that you're not getting because ChatGPT is just throwing in what you want to hear.
There it is. It could be, depending on the way you phrase the question, right?
Do you have any fear that you'll be replaced by AI?
Not necessarily. I don't know. I guess the one when I first got in the industry was the internet was going to be my undoing.
Oh, yeah.
And there is a space for that.
Well, because like Geico and Progressive and all of these just sold online, they can skip an agent altogether.
They can. And there is merit to doing so for individuals. I think within my own family, and my younger children, they are fully capable. They're on the phone. They know the technology. They can navigate it. They're also smart and informed, and they will read it. But they can do it, and so I think they could get along with that type of process fine. It's when things go sideways.
Yeah.
The claim doesn't get paid. For what reason? There's billing issues, whatever. With those 1-800s, with the onlines, it's going to be a phone call or a chat. You're going to get a different person each and every time. And if you're okay with that, and if the pricing is like, you know what, I saved $500 by doing this, then so be it, and roll that way. The insurance industry, we kind of did it to ourselves. We commoditized the insurance deal, and it isn't in any way. Every policy is unique. Every one of my competitors has things baked into their policy that we just don't know about. But what we did was we commoditized it, and we basically made it into a situation where it appears that insurance is insurance. Just get the cheapest one.
Yeah.
And that couldn't be further from the truth. I've had people that have come to me and said, I've got a quotation from one of your competitors, and they're going to save me XYZ, $500, $1,000, whatever. Okay, well, what are they? Can I see it? And if they're willing to share, we look at it and we go through it line item by line item. And the obvious standout is the premium, and it's less. But then we look at the various coverages, and maybe it's due to the fact that the competitor raised the deductible to twice the amount or whatever. And that's fine. I often say in my sales presentations, insurance there's not right nor wrong in insurance as long as you know what you're buying and how it's going to react at the time of loss. Yeah. If you're okay that I'm not buying this coverage, but you know you're not buying that coverage, I don't mind not selling it to you. I advise you should have it. But if you say, I get it, I understand it, I'm willing to roll that dice. Insurance is just a way to distribute risk. And how much do you want to put on the carrier, and how much do you want to take upon yourself? And so if you're okay with those things and have a complete understanding, and it's incumbent on me to document, possibly even have you sign some things, not just the application, but I offered you XYZ.
Enough coverage, and you
chose to go a different route, and that's kind of a CYA on my part. But I'm okay with those things as long as we've had a well thought out conversation and talked about those coverage differences and things like that. So I think that ultimately is and again, I'm always going to be biased to go with an agent versus the online version or whatever, because anybody can get an insurance license if you pay the money and don't have a criminal background. Even a person from out of state can get a non-residence license in Kansas. It doesn't make them a good insurance person.
Yeah.
And so with that, I'm biased and say that visit with your agent, talk to your agent, ask questions, probe. Don't take it just for granted that premium's less.
it's good enough.
They're doing me good service or whatever.
So I know some of these online providers, they offer like, oh, get a quote from us and we'll give you all of our competitors' quotes as well and all this. And you being an independent agent have that capability as well. Get multiple quotes from multiple agencies, multiple providers. Now, if I'm online and I go with one of the online carriers and then I do have a claim and I just call the number on the back of my insurance card or whatever, and I call that number and I'm just talking to whoever happens to pick up the phone.
Right.
If I'm working with you and I have a claim, do I call you? Do I call the office? Do I call the whatever carrier you connected me with? How does that work?
Well, and we try and establish that early in the conversation because I'm picturing my entire book of business. And there's some individuals when they call in a loss, and oftentimes they do come to the agent because they don't know where to begin. Mm-hmm. Sometimes they don't even know to flip the card and see if there's a number on the back or whatever. Depending on the individual, and we kind of know our clientele. Actually, even my predecessor, Joe McGuire, if he were to call up, we're going to hold his hand. We're going to walk him through the process. We're probably going to actually a certain age demographic. We'll invite them to come in the office. We'll sit down at a desk. We'll put it on speakerphone, and we will do this together. And that's required. Certain individuals will have the same conversation, and they're like, "Do you really need to be involved in this?" And I will tell them only as much as you need me to be.
Yeah.
And so in that situation, then we may tell them, there's an 800 number to call. But even that's become a bit analog, so to speak. Some people say, well, can I just do it all on my phone? Well, you can. But it's going to require you to take some pictures. Some of the companies I represent have what they call a quick photo claim, where you can take photos with your phone, send those in through the claim app, and have an adjuster adjust it almost immediately.
Without even having to be on site.
Without even having to be on site.
Wow.
You can have money in your account. It's seed money. It's not the amount to fix it, but it's going to be enough to get the repair person, maybe the roofer or the siter or the whatever we're talking about, to motivate to get on site or even make temporary repairs. But you can have money in your bank in like less than an hour. It's amazing. This is a different world we live in. That would not work for my predecessor. He would not be able to. I don't even know if he has a smartphone. I think he's still operating the flip phone. So with that in mind, that's another good point. The 1-800, the online insurance platform may not be for everybody, and they may only find that out at the time of loss.
Yeah.
Yeah.
And there is one company in particular, I won't use its name, but it's very well known, I think, for advertising a very low price, and then you sign up and your first 6 months are pretty low, and then the next time you renew, it's shockingly higher.
Okay, yeah. Some are known for teaser rate, if you will.
Yeah.
I don't know quite how they get away with that because, again, the filing wouldn't allow for them to do that in the state of Kansas. But it sure feels like after the first renewal, they see immediate jumps, or so I've been told.
Yeah.
And that just gets them in the door and so on and so forth. I'm dealing with a carrier. This, again, is more of an automobile situation or whatever, but it's topical, where the individual had a loss and the other party just denied the claim entirely and just wiped their hands of it. This individual had comp and collision on their car, so they had a route. They just felt they weren't at fault, so they didn't want to pay their deductible and do all that. There's a subrogation process that allows their carrier to go ahead and pay the loss, less the deductible, and then, hey, we'll go after XYZ company and send our team of lawyers. Even that hasn't motivated this other carrier to do that. So,
wow.
Yeah, it's interesting.
So we've talked about some of these dynamics over a long period of time that have kind of pushed insurance rates to where they are now.
Sure.
And a little bit about the effect that has, individually and at a community level. Do you see anything happening, or could you guess at all about, is there anything out there? I imagine you probably go to like professional development conferences and things like that. Is there anything out there that's going to start putting downward pressure other than premium increases?
Sure.
Is there anything that's happening in the marketplace that's saying this is getting unsustainable? Because at some point as an industry, that becomes unsustainable and you're your entire industry will start to suffer if we can't get these prices in check, right?
Correct.
So is there anything out there that's looking to kind of create some equilibrium?
Yeah, I think so. I think some creativity on the policies. I think, unfortunately, scaling back some of the broad coverages. We've seen some things that used to be standard included in a policy form that are being removed. I think creativity with even the roof schedule, which, again, no right nor wrong in insurance. If you're on the roof schedule and you know how it operates and the premium seems appropriate, it's not necessarily a bad thing. It's just a tool. But a change in the consumer side, like you said, I think most people are pretty aware that they don't turn in the willy-nilly claims anymore, and things like that. There are some groups that have come out as of late, and I've started representing some of them that have a creative model on how they arrive at their premium, and again, so much of it's proprietary that I don't know, and I'm not sure it's going to even work. But they're trying new things, trying to get creative on how they arrive at the pricing and that it be appropriate. Also, this push to get all homeowners to be insured, especially if they've got an insurance replacement cost contract, to be insured at replacement cost. That's going to help a great deal as well, because then they can charge and get the appropriate premium for the appropriate risk.
Okay.
Because, again, we can have a house underinsured for multiple years and nothing becomes of it because there's never a loss. But the minute we have a total fire loss or something like that, we find out that we weren't collecting, we being the industry, being the insurance company, weren't collecting the appropriate premium for the amount of risk that was there. The claim still has to be paid, and they're going to pay it in full. And a lot of them have riders in there that says even if the coverage A, which is the property coverage, is not adequate, some of them have a built-in rider that adds an additional 10 or 20%. So they were going to pay it regardless. Mm-hmm. Not all, but some do. But they were never collecting the appropriate amount of premium to do so. I feel like, even though it sucks, I don't think there's a more professional term, but the premiums are more commiserate with the risk than they ever have been. So I think that could lend to some rate stability that we used to enjoy. Again, if I had a crystal ball, I feel like we're at the peak and things should start to level out. The pain points that we've suffered specifically in the last 3 to 4 years, but honestly over the last decade probably to a certain extent, I feel like they're starting to level out.
Well, and I think one of the things that, and again, I would be remiss if I didn't bring this up, but like insurance premium increases are based on a lot of legitimate factors when we look at the market and what's happening. But again, at the individual level, like if you're a retired senior in your home, and even if it's paid off, that's a cost you have to absorb without an ability to increase your income.
Correct.
And this is creating a lot of strain in the overall environment, right? If you're on the lower end of if you're a working family and you don't have like a way to like increase your income, you're stuck in that spot. And that has a cost on the broader economy. I think this is one of the things we always forget about any of our economic conversations is something here is money that would be spent here. So whether it's we spend 20% of GDP in this country on healthcare, that is 20% of Americans' incomes that can't go to other things in the economy. And the same dynamic would exist with homeowners insurance too, and that we're taking some money out, particularly for like seniors and people that don't have a way to increase their income. And we don't really have policies that offset that at all. I'm aware of.
Yeah, you're absolutely correct. Again, some creative stuff that's coming on board is they're now selling, mostly in the commercial space, but if it works there, I think we'll see it in the personal line space, is some more tools in the toolbox. Basically, it's like an insurance deductible policy. So it allows you to take on your homeowner's policy a high deductible, and then you buy a secondary policy that's basically almost like a reinsurance situation. Okay. That allows that to help offset that. So you take a $10,000, a $15,000, a $20,000 deductible on your homeowner's policy, but then you buy this smaller policy, which then lowers the premium on the homeowner's policy.
But then you buy a policy to cover
to help
the deductible.
offset the deductible side.
Interesting.
Again, it's come out of necessity, and I'm not sure it's the fix. And honestly, I just wish everything would level out and we could just take a breath and say, okay, this is the new norm, and let's figure out what it takes to do so. Cost of living increases, other things that could come into play. But it's another attempt to help
to try to find a tool
that might help offset some of that. Again, I know they're trying to crack the nut because I think they also recognize, they being the industry, that again it's untenable, right? Like the only way to truly offset this would be to continually increase the insurance premiums on the consumer, but eventually that will break.
Yeah.
And people will just say, I can't.
Yeah.
And then they won't.
Yeah.
And that would be devastating.
Well, then that hurts every other part.
That would help. Yeah, because again, insurance at its basis is a collection of dollars, and if you don't have the healthy offsetting the sick, in this situation, homes, it would be the good properties offsetting the ones that are more prone to loss.
Yeah.
If those people pull out of the market, then it would also have devastating effects.
There are two things that, and this is a little out of place where I'd rather have them in the conversation, but you brought up reinsurance. Mm-hmm. Can you explain that to people? Because I think we hear that a lot. I don't know that everyone knows what that is.
Sure. So every insurance carrier, one, they must have enough in reserve to pay all the losses for all their policyholders at any given time, or percentage thereof. There's some equations that come into that. With that, then, they have their own deductible, if you will. And so if there was a catastrophic loss, consider a hurricane, consider a large wildfire, a tornado. The insurance company, XYZ, would pay up to a certain amount. After that, that would be their deductible, if you will.
Okay.
They would pay, and by their deductible, I'm talking millions of dollars, right? So they will pay the first 10 million, 15 million, 20 million. If the catastrophe exceeds that, the reinsurer will pick up the difference and pay it out. We have reinsurers that reinsure reinsurers. Because the losses are becoming so large. So again, take your State Farm, take your Allstate or whatever. They're hit by a tornado, hit by a hurricane or whatever. They're going to pay maybe $100 million, but it's a $400 million, $500 million loss. Then the reinsurer will pay after the first $100 million, and then go on from there. But now we're talking losses getting into billions of dollars.
Yeah.
So those reinsurers have their deductible with their reinsurer, and they will pay X amount and before somebody else picks up the difference. The further you get away, the further you are from the risk, and you hope that it's a small loss and you don't participate in it as a reinsurer. So you would love to be second, third, fourth, fifth position, right? The reinsurer of the reinsurer of the reinsurer. But because the losses, the catastrophic losses are becoming so large, it's reaching out.
Starting to reach up.
It's reaching out that far. Yeah.
Wow. The other question that I had that I've seen the term or I've heard the term before, act of God. On insurance policies. What does that mean, and how is it used? And I've actually had discussions where you could make the argument that everything is an act of God.
Right, yeah, I was going to say depending
on your personal beliefs. But there are exclusions to, right, on some policies, there used to be at least an excluding an act of God.
Okay, so I've never seen it, and I've read a lot of policies, but I'm very familiar with the term, and I even to this day, yourself included, but others have brought that up, but it's an act of God or a thing like that. You will not find, at least not to my knowledge, and again, I have to qualify that statement, I only represent so many carriers and so many policies I've read or whatever, but on the standard forms, which most carriers subscribe to, you will not find the verbiage act of God anywhere in there. Again, it goes back to named perils, and then the type of coverage, whether it is based on the named perils or anything that's excluded.
Okay.
But yes, every once in a while, the act of God. Oftentimes I think recently I've had that. It usually comes from a neighboring dispute. His tree fell on my fence, type of thing.
Okay.
And who pays for it or why?
Yeah.
That type of thing. And actually that one blows people's mind. Well, it's his tree. Well,
It's your damage.
It's your damage,
Yeah.
and we insure your property.
Yeah.
So we insure your fence. So even though his tree fell on your fence, we insure your fence. We're going to be the ones paying, not his insurance.
Yeah.
But it was his tree. Well, and I say that I had one occasion in my 20-plus years where the tree was in horrible repair. The neighbor had written letters and complained and told him this thing's going to fall any minute. And then subsequently, 5 years later, after multiple warnings, the tree fell. They did find that the guy was liable because he was fully aware that the tree was in bad shape and chose to do nothing about it. And they did end up paying the loss on that one.
Okay. I'll try to tell this joke. I'll probably butcher it, but I can't remember. It's insurance. It makes me think of it. There's a guy from Missouri, a guy from Arkansas, and a guy from Louisiana all getting together having a beer. And they're all commiserating about how they lost their homes and their businesses. And the guy, one guy says to the guy in Missouri, what happened to you? And he said, oh, I lost my home and my business in a fire. And they said, oh, that's just too bad. It's too sad. And they asked the guy in Arkansas, they said, what happened to you? And he said, well, I lost my home in an explosion. It was just a big gas explosion. Lost everything. And then they asked the guy in Louisiana, what happened to you? He said, well, I lost everything in a flood. The guy from Missouri and Arkansas said, how'd you start a flood?
How do you start a flood? There it is. There it is. Yeah. So there is some complications of premium around fraud as well, but maybe we'll save that for another conversation also. Yeah, exactly.
Is there anything else like that we should touch on? Insurance is a huge, big, complex system.
Sure.
You've done a good job, I think, of kind of like making this part of it really understandable.
Sure.
But especially for consumers, what else should they know about homeowners insurance and what's going on and I guess how to navigate this system?
Sure. Another one, and it's a market that's underutilized, but it's called the HO4, but it's the renter's insurance policy. I would advise anybody that rents, they might consider looking at those. Those, from a premium standpoint, have remained relatively inexpensive. And it could be a huge benefit if ever exposed to some sort of loss. Again, it's going to cover the individual's contents for their rental property, which may or may not be a large sum, but I put more of an emphasis on the liability side again, because if you were to inadvertently burn down the joint, the home owner, the property owner, probably has insurance, but there's nothing suggesting that insurance company can't try and come back upon the tenant and try and subrogate. Not that they would necessarily, but they could. Or if you're in an apartment complex of sorts, if you were to start something and it takes out the unit on either side of you, for whatever reason, flood, fire, this thing, that. Again, the property owner probably has some coverage. The individual may or may not have their own renter's policy. If they don't, you might be on the hook for that if you're held liable. Like I said, the premiums, top of my head, I think for like $25,000, but then maybe $100,000 or $300,000 in liability, a couple $100 a year or something like that. I mean, those numbers seem very reasonable compared to the other. I guess there's nothing to say that an individual, and I've had that conversation with individuals that talked about, okay, I paid off the mortgage, I no longer want to do this. In that situation, then I usually offered them some sort of a HO4 renter's policy. Okay. You would pick up your liability, you would still have coverage for your contents on a named peril basis, but the bulk of the expense would go away. I would highly suggest that you sock away some money for those incidentals, and just recognize that in the event of a large loss, a total loss, you're going to be exposed, or whatever. But you can offset that possibly by increasing the amount of personal property coverage, and maybe not replacing all that you had or whatever. Again, I just go back to talk to whoever sold you the policy, go over the nuances, anything I need to know. Is anything going to change over time? Also, it's not, even though I told you we commoditized ourselves, it's not a buy it and forget it type of a product. It's a
Kind of a living document, right? Yeah.
And especially as your needs change over time. And it can be adjusted accordingly. And we can go to a high deductible today, but that is certainly can be reversed when economic circumstances change. Okay, I'm in a little better financial position now. Let's put it back to a more manageable deductible or some other such conversation. So I'd say just visit with whoever sold it to you. I win business and I lose business this way, but it's probably advisable to have somebody look at it competitively every couple, 3 years or something like that. Not necessarily to do it annually. Definitely look at your policy annually, but I wouldn't suggest shopping it annually.
Because that can actually affect your premiums too, right?
As well, yeah. Lack of history and things like that. So if you come in with a strong history of a lot of time, then that can be figured into the rate. So different things like that. Just having those conversations, it's not a bad thing. Yeah,
lots of conversations to have around insurance. Yeah, maybe one of these days we'll come in and tackle health insurance, but I probably need to be in a better frame of mind.
There it is.
Because it would be a scathing screed on I'm ready to burn health insurance to the ground.
There it is. And again, licensed to do it, and I follow it adamantly, but I don't live in the space. But I'd love to have the conversation.
Yeah, we can do that sometime.
Cool.
All right, thanks for coming in today.
Absolutely. Thanks for having me.
Yeah. I'd like to thank a few of the people who've helped make that podcast and Hutch possible. My son Mitchell Probst wrote and recorded the music for the show. Jenny Brigette put together some great graphics and promotional art. And Chris Acker helps overcome my mistakes to produce a great sounding product every episode. That podcast and Hutch is made possible through a collaboration between the Hutchison Arts and Culture Collective and Salt City Sound. They're working to bring resources and infrastructure to support art, music, and storytelling in our community. If you have an idea for your own podcast, reach out to them at podcasts@saltcitysound.net. If you enjoy that podcast and Hutch, be sure to subscribe and share it with all your friends. You can also help support this production by subscribing to thatguyandhutch.substack.com or by emailing me at thatguyandhutch@gmail.com to learn about sponsorship opportunities. Thanks for listening, and I hope you'll join us again next week.
A Salt City Sound production.